We're also looking at another part of China's high-tech sector, with Tencent launching its own new AI product that it says outperforms DeepSeek. We're joined by Bloomberg Intelligence senior analyst Robert Lee here. Just kick off, what does this mean for Tencent?
Okay, I think starting on a positive, the big tech platforms, not just in China but globally, stand to benefit from utilizing AI within their businesses to drive efficiency and cost savings. So Tencent, as I think I've said previously, is playing the long game in AI. They're not in a rush. They avoid the hype and hyperbole. So they're still a leading tech platform in this part of the world. They've got very deep technological and balance sheet resources. They've come out with their latest model, which, again, they're claiming beats DeepSeek on some measures. But as we know and as we've seen in recent weeks, I wouldn't be surprised if another company comes out next week and claims something different. So I think Tencent stands to benefit by applying this within its own business to drive savings. Is that going to have a transformative effect on their earnings outlook? Probably not, but at least there is some potential benefit for them. And then the more important question, as I might have mentioned once or twice previously for the industry, is how are the rest of the companies going to monetize their developments? Because humongous amounts are being spent on capex. Consumers are not really putting their hands in the pocket at the moment. And, you know, we still remain at a very early stage in terms of the commercialization of this technology.
Yeah, I mean, it's funny how markets behave, don't they? You know, the lack of visibility on the monetization on Chinese tech has driven a lot of money in. The opposite side of that is Nvidia, which has told us they will make $40 billion in sales as far as the guidance goes. So that's clear. That's almost money in the bag, but yet markets reacted and sold the stock of 8%. So what do you think was behind this indigestion of that information?
Well, again, as we said before, the Nvidia story is extremely well known. It was priced to perfection previously, very high expectations, high valuation. But I guess the narrative on Nvidia, you know, is shifting, it's changing, and people are beginning to focus more on the risks that the company faces. Again, the numbers speak for themselves. The company's still doing extremely well and will continue to do in the short term. But what are the risks to that outlook? Because the rate of incremental upside or incremental outperformance, not just stock price, but in terms of earning outperformance, doesn't seem to be coming through. Maybe that's partly the base effect. You know, we've had beat and raise for so many consecutive quarters. As the base grows larger, it just becomes so much harder to do that. But the narrative, I think, is changing on some of these big tech names because whilst they remain an effective monopoly in terms of what they're doing, there are risks. There are risks in terms of competition, you know, such as Broadcom and Marvell trying to catch up. Some of their customers are now designing their own chips. As I said, the bullish outlook is extremely well known. We had a story break in the States, I think about a week ago, from a broker claiming that Microsoft was beginning to pull back on some of its AI data center rentals. So again, you know, the bull case was priced in. The narrative is shifting, you know, I think across the sector.
Okay, 30 seconds or less. Are we in an AI bubble?
Look at Nvidia's stock price. You know, that peaked roughly in the summer of last year. It struggled to maintain the highs since. So I think I'm not questioning the narrative, but again, there was a lot of hope, a lot of hype priced in. It's all about show me the money. It's all about monetization. I think that's where people should be focused for this year.
Robert Lee, fantastic. Thank you so much. Out of Bloomberg Intelligence there.